I'm not going to waste your time. Blackstone is quietly becoming the biggest landlord in America, and the way they're doing it could reshape housing forever. Families across the country are being priced out of homes, not just because of high interest rates or low supply, but because massive Wall Street firms are competing against them and winning. This isn't a conspiracy theory. It's happening right now. In this video, I'll show you exactly how Blackstone built its empire, why it matters for you, and the 10 ways this corporate takeover is changing the American housing market. So let's get straight into it. After the 2008 financial crisis, millions of Americans lost their homes to foreclosure. Families were forced out, entire neighborhoods sat empty, and the housing market looked like it would take decades to recover. But where most people saw tragedy, one company saw an opportunity. That company was Blackstone, a Wall Street investment giant with billions of dollars at its disposal. Blackstone began quietly buying up single-family homes at rock-bottom prices. Instead of reselling them to families who needed housing, they held on to them and transformed them into rental properties. At first, no one paid much attention. After all, who would complain about empty homes being filled again? But over the next decade, Blackstone scaled up in a way no one had ever seen before. They weren't just buying a few houses here and there. They were buying thousands, entire blocks, entire neighborhoods. This made Blackstone the largest landlord in America, with tens of thousands of homes under their control. And here's the part most people don't realize. When one company owns that much housing, they don't just follow the market, they shape it. By outbidding ordinary families with all-cash offers, they effectively shut out first-time buyers. This forced more people into renting, and with Blackstone owning so many of those rentals, they could raise rents almost at will. What began as a crisis in 2008 turned into a permanent shift in the way Americans live. The dream of owning your own home is slipping away for millions, replaced with the reality of renting from a faceless corporation whose only goal is profit. And while Wall Street celebrates their massive returns, everyday people are left wondering, how can we compete when entire neighborhoods are treated like stocks on a spreadsheet? Blackstone's rise to power wasn't an accident. It was a calculated strategy fueled by billions in investor money, weak regulations, and a housing market too battered to fight back. And the scariest part? This is only the beginning. If you think Blackstone stopped after scooping up foreclosed homes, think again. What happened next was nothing short of a gold rush. Not for families, but for Wall Street. See, once Blackstone proved you could make massive profits by buying up single-family homes and renting them out, the floodgates opened. Other hedge funds, private equity firms, and institutional investors jumped in, turning neighborhoods into a battleground between regular families and billion-dollar corporations. But here's the problem. When Wall Street enters a market, the rules of the game change. Families looking to buy their first home usually rely on mortgages, inspections, and negotiations. It takes time. Blackstone and other investors don't play by those rules. They come in with all-cash offers, often above asking price, and they close in days, not weeks. For a seller, it's an easy choice. For the average buyer, it's an impossible competition. And what happens when Wall Street buys instead of families? Ownership declines while rental markets expand. It creates a vicious cycle. Fewer people can buy, so more people are forced to rent. With fewer homes available to purchase, prices skyrocket even higher. And who sets the rental rates? The very same firms that corner the market. This isn't just happening in one or two cities. From Phoenix to Atlanta to Tampa, the story is the same. Working-class families lose bidding wars, while investment companies rack up entire blocks of homes. To them, it's a portfolio. To you, it's where you're supposed to raise your kids. The single-family rental gold rush might sound like a business success story, but at its core, it's about power. Housing is supposed to be a human necessity, not a Wall Street asset. And yet, firms like Blackstone are rewriting that rule right under our noses. When one of the largest investment companies in the world decides your home is just another financial product, you're no longer competing in the housing market. You're competing in Wall Street's casino. And the house always wins. I'm not going to waste your time because this one cuts deep. When Blackstone and other corporate landlords step into the housing market, They're not just buying properties. They're reshaping what it means to rent in America. And for tenants, that shift often means one thing: evictions. Here's the reality. Unlike a local landlord who might know your family, understand your situation, or even give you a little extra time to make rent, corporate landlords operate like machines. If the rent isn't in on the first, the eviction notice can be out on the second. There's no face-to-face conversation, no second chances, just algorithms and legal departments churning out paperwork. During the pandemic, Blackstone's rental arm came under fire for aggressively pushing evictions even as millions of Americans were struggling. And while many small landlords were willing to work with tenants, corporate giants moved full speed ahead. Why? Because to them, tenants aren't neighbors, they're line items. Studies have shown that corporate-owned properties often have higher eviction rates than homes owned by individual landlords. That means entire neighborhoods where stability crumbles, families are displaced, and kids are forced to change schools because the rent was raised or the grace period vanished. And here's the kicker. When families are evicted, these same firms can raise rents even higher for the next tenant. It's a cycle that doesn't just punish the most vulnerable, it profits from their displacement. Think about it. You're not just renting a home anymore. You're renting from a system designed to squeeze out maximum return for investors. And in that system, compassion doesn't exist. Only margins do. This is why the debate over corporate landlords isn't just about ownership. It's about control. Who decides whether you get to stay in your home? Increasingly, it's not your local landlord. It's a billion-dollar firm whose headquarters are thousands of miles away, with shareholders who never set foot in your neighborhood. And once again, this isn't limited to one state or one city. From Las Vegas to Charlotte to Dallas, tenants have been sounding the alarm. When Wall Street becomes your landlord, the rules of the game change. And not in your favor. I'm not going to waste your time, because this one hits almost everyone. If you've noticed your rent going up faster than your paycheck, there's a good chance Wall Street has something to do with it. And Blackstone is at the center of that storm. Here's what happens. When a massive firm like Blackstone buys thousands of homes, they don't just sit on them. They run them through financial models designed to squeeze out every dollar possible. That often means systematic rent hikes across entire neighborhoods, not just 1 or 2 units. And because these companies own so many properties, they don't have to follow the market. They set it. Think about it. A local landlord might hesitate to raise rent too high because they don't want to lose good tenants. But a corporate landlord doesn't care about loyalty or stability. They care about numbers. If you can't pay the new price, someone else will. And if no one in your neighborhood can pay, they'll simply reposition the property for higher income renters or even short-term rentals. In cities like Atlanta, Phoenix, and Tampa, researchers found that corporate landlords like Blackstone raised rents faster and higher than individual landlords. In some cases, increases jumped more than 30% in a single year. For families already stretched thin, that kind of spike isn't just painful, it's devastating. And here's the most alarming part. When rent hikes happen on such a large scale, it creates ripple effects across the entire housing market. Suddenly, renters who wanted to buy can't save for a down payment. Families are forced to move further from jobs and schools. And middle-class neighborhoods start hollowing out as only the wealthiest tenants can keep up. Blackstone doesn't call it exploitation. They call it market efficiency. But when your rent goes up hundreds of dollars overnight because a spreadsheet says it should, you start to see the difference between a home and an asset. This isn't just a housing issue. It's a quality of life issue. And until we address how corporate landlords weaponize rent hikes, millions of Americans will remain stuck paying more for less. Across America, affordable homes are becoming harder and harder to find, and Blackstone has played a key role in that shift. Here's how it works. When Blackstone and other corporate investors target starter homes, the smaller, lower-priced houses traditionally bought by first-time buyers, they don't just compete with families, they outmuscle them. With cash offers, quick closings, and the ability to buy in bulk, they remove these homes from the pool of affordable options. What once could have been an entry point into homeownership now becomes a long-term rental. This creates a domino effect. Families that might have purchased a modest home are instead locked out of ownership, stuck renting at ever-increasing prices. Meanwhile, the supply of affordable homes continues to shrink, driving prices even higher for the few that remain. It's not just economics. It's a structural shift in who gets to own property in America. Blackstone has often defended its actions by saying they provide quality rental housing to people who can't buy. But that ignores the larger truth. By buying up the very homes people want to purchase, they're creating the problem they claim to solve. The more properties Wall Street controls, the fewer opportunities exist for everyday Americans to build wealth through homeownership. And this isn't a niche issue. Affordable housing stock has been falling for years, and corporate ownership has only accelerated that trend. In cities like Las Vegas, Charlotte, and Dallas, entire neighborhoods of once affordable homes are now dominated by rental companies tied to Wall Street. For decades, homeownership was the foundation of the American dream, a way for working families to secure stability and build generational wealth. But when firms like Blackstone transform starter homes into permanent rentals, that dream slips further out of reach. What's left is a cycle of dependence, where families pay more each year but never get the chance to own the roof over their heads. The disappearance of affordable homes isn't just a market trend. It's a transfer of opportunity from millions of working families to a handful of powerful investors. One of the biggest promises Blackstone and other corporate landlords make is that they provide professional management for the homes they own. On paper, that sounds great: faster service, more consistency, fewer headaches. But for tenants, the reality has often been the exact opposite. Maintenance nightmares that leave families stuck in unsafe or unlivable conditions. Reports from tenants across the country tell the same story. Requests for basic repairs, leaky roofs, broken air conditioning, mold infestations, plumbing issues are met with delays, unresponsive call centers, or cheap patchwork fixes. Instead of local landlords who might swing by to check on a problem, tenants are routed through faceless systems where accountability is nearly impossible to find. And it's not just inconvenience. In places like Atlanta and Memphis, tenants living in Blackstone-owned homes have reported serious health and safety issues left unaddressed for weeks or months. For families with children or elderly residents, that isn't just poor service, it's dangerous. Why does this happen? The answer is scale. When a company owns tens of thousands of homes across the country, maintenance becomes less about individual care and more about cost management. Cutting corners saves money. Delaying repairs protects quarterly earnings. And for a corporation beholden to shareholders, those priorities often outweigh the needs of tenants. What's worse, tenants often pay higher rents for these corporate-owned properties than they would with individual landlords. In other words, families are paying more but receiving less. It's a business model that extracts maximum value from the home while minimizing investment in the people living inside it. This model also undermines the very idea of housing as stability. A home is supposed to provide safety and comfort, but when repairs are ignored and costs keep climbing, that foundation collapses. Families are left stressed, vulnerable, and powerless in a system designed to favor investors over residents. Maintenance nightmares reveal the truth about corporate landlords. They aren't in the housing business to provide homes. They're in it to generate returns. And when profits and people collide, it's the tenants who pay the price. For decades, buying your first home was a milestone, a chance for families to stop renting, start building equity, and secure long-term stability. But today, more and more first-time buyers are discovering that they're not just competing with other families. They're competing with Wall Street giants like Blackstone. The competition isn't fair. First-time buyers often rely on FHA loans or conventional mortgages, which take time to process. Offers include inspections, appraisals, and contingencies. Meanwhile, firms like Blackstone come in with all-cash offers, sometimes tens of thousands above asking price, and they close in days. Sellers, naturally, take the easy win. The result? Families lose out before they even have a chance. And this isn't just happening occasionally, it's happening systematically. In some markets, institutional investors accounted for up to 30% of all single-family home purchases. That means nearly 1 out of every 3 homes that could have gone to a family is instead added to a rental portfolio. For first-time buyers, the fallout is devastating. They're priced out of neighborhoods where they grew up. They're forced into bidding wars they can't win. And even when they do manage to land a home, it often comes at a much higher cost than it should. The larger consequence is generational. Homeownership has long been the primary way American families build wealth. When corporate landlords box out first-time buyers, they're not just disrupting individual lives. They're stripping away the opportunity for entire generations to build financial security. Wealth that could have been spread among millions of families is being concentrated in the hands of a few massive firms. Blackstone argues they're providing rental housing. But let's be clear, they're part of the reason so many people do. By turning homes into investment assets, they're shifting the balance of power in the market from families to financiers. Wall Street versus first-time buyers isn't just an economic story. It's a story about fairness, opportunity, and who gets to live the American dream. And right now, Wall Street is winning that battle. When most people think of Wall Street, they picture stocks, bonds, and maybe some complex financial instruments they don't fully understand. But here's a twist you probably didn't expect. Wall Street has figured out how to turn your monthly rent check into a tradable asset. And Blackstone helped pioneer the process. It's called rent-backed securities. The idea works a lot like mortgage-backed securities, which played a major role in the 2000s.